had a check. So where we left off at, we left off talking about the audit risk model. And the importance of the audit risk model is the framework that auditors use to determine the nature, timing, and extent of the audit procedures that they're going to perform. So remember I said that the audit approach is a risk-based approach. So the risk assessment process is extremely important because if the auditor does not assess risk effectively and appropriately, then it's going to impact audit quality because they're not going to adopt or adapt audit procedures that are required to address that risk. So if you remember on Tuesday, we talked about the auditing standards related to risk. Right? So to just recap, the auditing standard number 8 deals with what is the objective of the risk assessment. And the auditor's objective should be to keep audit risk relatively low. Right? So the standard does not say that auditors have to keep it low. That is what the standard suggests. It is still the auditor's judgment because it's the audit firm's risk, right? It's the audit risk. That's what they control. It's the audit firm's judgment as to how much risk they're willing to accept. So that's very much a judgment-based decision. Of the 4 components of the audit risk model, the only 2 components that the auditor actually controls is audit risk and detection risk. The detection risk is the response to the auditor's assessment of the risk of material misstatement, which is inherent risk and control risk. Those are the risks that is based on the client's environment, that is generated based on the client's environment. Right? It's the client's financial statements, the client's company, it's the industry that they operate in. The auditor has no control over these things, so they just assess that risk. So it's important to recognize that the risk of material misstatement represents inherent risk and control risk. And those are client-generated risks. So based on the auditor's assessment of the risk of material misstatement, that is going to determine the amount of risk that the auditor will accept, that given the audit procedures they perform, they will not detect a material misstatement. And if the goal or the objective is to keep audit risk low, then the auditor has to adjust the amount of risk they're willing to accept if they will not detect a material misstatement. But it's going to be driven by their assessment of the risk of material misstatement. Make sense? Audit Standard 12 deals with the risk assessment process. So it talks about the factors that auditors should consider, things that they should consider when assessing risk. So when assessing the risk of material misstatement, and auditing standard number 13 deals with the response to that risk assessment. So the risk assessment process is extremely important, and auditors have to get it right. And it's very judgmental, right? Because there's no formula that tells you how to calculate inherent risk, nor is there a formula that tells you how to calculate control risk. It's all based on how auditors view the risk factors, if they're able to identify all of the relevant risk factors that would impact the risk of material misstatement. So let's talk about inherent risk. Again, inherent risk is the risk that's born out of the client's environment. And inherent risk is defined as the assessment that there may be a material misstatement before considering internal controls. So the assessment of the likelihood that there is a material misstatement before considering internal controls. And so think about when we talked in chapter 3, we talked about understanding the entity that you're auditing. The auditor has a responsibility to understand the entity that they're auditing. And the things that they consider are what kind of industry is it in? What are the business processes that the client engages in? What kind of transactions do they have? Are they complex transactions? Are are there a lot of subjective estimates? So those are the types of things that, again, the auditor has no control over, but they're required to assess that. So that's inherent risk, because those are the types of things that could increase the risk of a material misstatement, right, from an inherent. So if you have more complex transactions, or transactions that are subjected to, that are more subjective, right, where it requires more judgment, right, that increases the risk of material misstatement before you consider internal control. So some examples would be dollar size of the account, liquidity, the volume of transactions, how complex the transactions are, whether the client is going to have to report under new accounting pronouncements, and again, the subjectivity of the estimates, such as the allowance for doubtful accounts. The relationship between inherent risk and detection risk is inverse. So the higher the auditor assess inherent risk, that means that they perceive a greater risk of material misstatement. The lower the risk that they're willing to take, that their audit procedures will not detect that material misstatement. So therefore, they're going to want to gather more evidence. How do you lower your risk? By gathering more evidence, right? Because evidence provides the auditor with information, and more information, or more of the right information, should reduce your risk. Make sense? So it's an inverse relationship. Control risk. Control risk is, again, based on the client's environment. And control risk is the assessment that the auditor makes about the client's system of internal controls. Whether or not the system of internal controls is effective in that it will prevent or detect on a timely basis any errors or misstatements before they enter the system, or if they enter the system, it's detected on a timely basis. Prevented or detected. So you expect to see, the auditor would expect to see controls in place to monitor, for example, let's say the client calculates the allowance for doubtful accounts. So if the allowance for doubtful accounts is handled by someone, let's say, who is in accounts payable, in the accounts payable department, well, that might increase control risk, right? Because that person, could argue, wouldn't be knowledgeable enough about accounts, the collection of accounts receivable. If the accounts, the allowance for doubtful accounts was conducted and not, or performed, or estimated by, and an entry was just reported without it being reviewed by someone more knowledgeable. If write-offs were, if someone was allowed to make a write-off without the approval, well, those are all lacking control. There's no review and reconciliation. There's no oversight. There's no accountability. So that increases the chances that there could be an error or a misstatement. That would be considered an ineffective internal control. And so therefore, control risk would be perceived as being higher in that area. Because in that case, there are no controls to prevent or at least detect on a timely basis a material misstatement or an error from entering the accounting information system. So the relationship between control risk, the auditor's assessment of control risk, and detection risk, again, is inverse. If there's higher control risk, that increases the risk of material misstatement. And in order for the auditor to lower their risk that they won't catch the material misstatement, they're going to want a lower detection risk, and they're going to gather greater evidence. So the relationship between the risk of material misstatement and detection risk is then what? What's the relationship? Right. The higher the risk of material misstatement, the lower the risk the auditor is willing to accept that their audit procedures will not detect that misstatement, and therefore they're going to gather greater evidence. Okay, so those two components or factors, risk factors, influence the risk of material misstatement. The auditors assess the risk of material misstatement based on client information. Yes.
So even if there's low risk of material misstatement or low risk of control,
low risk. So risk of material misstatement consists of risk, inherent risk, and control. So low risk.
So if inherent control is even if that was wrong, like how could you say detection risk has opportunity higher? Because according to skepticism and conservatism, those you always have to gather more evidence.
So you have to gather sufficient and appropriate evidence based on your risk assessment. So let's say, for example, you have, that doesn't mean you won't audit that account. It just means that you might use different. So with detection risk, that's going to drive the nature, timing, and extent of your audit procedures. So in that situation, you're saying I have low risk of material misstatement because my controls are effective and there's a low risk of low inherent risk. Right? So the auditor would choose to audit internal controls and perform less tests of account balances because the controls over that area is so good that it will prevent or detect. Their assessment is that it will prevent or detect any material mistakes within it. I know the concept of being willing to accept higher risk that you won't catch something seems counterintuitive based on exactly what you said, skepticism, conservatism. But the idea being, and this is judgment, that, okay, if I assess the risk of material misstatement as being low, I'm basically saying that the client has a very effective system of internal controls, and so therefore, and the inherent risk factors, let's say they have good tone at the top, their management has high integrity, and they're only concerned about getting to the right number, they're not chasing analyst forecasts, so inherent risk factors are low. Simple transactions is low. So what the auditor is basically saying, the fact is that the chances that there will be a material misstatement is low, right? Because the client has a well-controlled environment. The client monitors the environment, right? They might have low incentives to misstate, right? So because that risk is low, the chances of there being a misstatement that will enter the system and not be detected is low. So my procedures I don't have to develop procedures to detect that, right? I'm still going to audit, right? Gather evidence, but the amount of evidence that I gather, I don't have to over-audit this account, right? Because there's a low risk of material misstatement. So that doesn't mean I'm not going to gather evidence. An example might be, let's talk about repairs and maintenance. So let's say that the company has really good controls over repairs and maintenance. Repairs and maintenance, the repairs and maintenance is very standard. And again, there's low risk that they would capitalize repairs and maintenance. So in that case, and the number, it doesn't change from year to year. It's pretty stable, right? There's no significant fluctuations in repairs and maintenance. Then the auditor might decide that not that they're not going to look at repairs and maintenance, but that they'll perform analytical procedures, right? They'll just look at changes in repairs and maintenance from year 1 to year 2, look at repairs and maintenance as a percentage of the cost of the fixed assets, and say, okay, this is reasonable. That's the difference in the nature of the testing, right? So when we talk about the testing, it changes the nature, timing, and extent of testing. It doesn't mean that you don't gather audit evidence. Okay, question? Any other questions about that? Okay, so again, detection risk is the risk that the auditor is willing to take. So again, the detection risk is what the auditor controls. it's their response to how they assess the risk of material misstatement. So that's the risk they're willing to take, that they will not uncover a material misstatement if there's indeed a material misstatement in the account, in the financial statements. And that's going to, again, determine the amount of substantive testing you do. There's an inverse relationship. The lower your detection risk, the lower the risk that you're willing to accept, the detection risk that you're willing to accept, the more evidence you're going to gather. So again, if you determine that there's a higher risk of material misstatement, let's say, for example, the client's controls are not effective in a particular area, then it wouldn't make sense to test controls. You're not going to test controls because you just decided that or assessed that it's not effective. So as a result, the nature of your testing will change. So you're going to look at a lot more transactions, look at account values, test a lot more, greater evidence. You've changed the nature of that testing, right? You shifted from looking at controls to just performing substantive testing, looking at substantive tested transactions, detailed tests of account balances. You're looking at more transactions, and you're looking at also the timing. You would never audit an account back before year end in that case, because the controls are not effective. So you've changed the nature, timing, and extent of the audit procedures. Also, one of the things that auditors do, we'll talk a little bit about this later in the semester, is sampling. We talked about the fact that auditors cannot look at 100% of the transactions. So they have to select a representative sample of the population that they're testing. So for example, if they want to test occurrence, and we're talking about occurrence related to the revenue cycle, where do you think they're going to draw their sample from? This is called exam review too. What does the auditor tell us? When the auditor is testing occurrence, what are they testing? What's management asserting?
That the transaction actually took place.
Right, that it occurred. So how would they test that?
Source documents.
What source document?
Purchases, I'm guessing. Purchase orders or
Well, the
invoices.
purchase order is something.
I mean, no, invoices, right? Sales.
Sales. Sales receipts. So you go to the sales journal. They're going to select a sample of transactions from the sales journal and do what?
Trace it back to the invoice. If the seller actually
Shipping document. Right, because that gives us evidence that this transaction, the revenue was earned. So in that case, the auditor has to know the representative sample, right, would be, if they're testing occurrence, revenue, and the revenue cycle, the representative sample will be the sales journal. I'll select a sample of transactions from the sales journal. What if they selected a sample of to test occurrence? What if they selected a sample of transactions from shipping documents? Would that be representative of occurrence? Why not?
Is that like inverted? The list of the next five?
Isn't that rights and obligations?
Completeness and occurrence, that's
Yep.
the opposite.
Right. So why would it not be appropriate to test occurrence to select from shipping documents? Because what does a shipping document? What would that test tell us? Yes.
Well, it's like what's bottom down your head, it's no longer yours, right? So like it's not like you're responsible, so it's not.
Well, it doesn't have to do with occurrence, right? It won't tell you anything about occurrence. It's not so much that it's no longer out of your hands, but you're just testing whether a sale occurred. Or you want to test whether a sale occurred. Shipping starting with the shipping document would be an unrepresentative sample, right? Because the shipping document will only tell you that it's complete, that for this item I shipped, I reported it. That doesn't tell me anything about those items that are in the sales journal, whether or not they're valid. That only tells me that for the sample that I selected for the shipping documents, they're valid. right? They're complete, but I don't know about the rest of those items. So you have to go both ways. Right? So even though we're talking about shipping and sales and revenue rather, we have to think about what's the objective of the test. And so given the objective of the test, where should I be selecting my sample or representative sample? So the auditor has to know that. And when they select from an unrepresentative sample, that increases the risk. So, and if they increase their sampling risk, then that's going to impact their detection risk, right? Because they're not designing their audit procedures effectively to address the risk. Make sense? Yes, no? You want it to make sense now, today. Okay. All right. And non-sampling risk is just based on auditor judgment, right? So non-sampling risk basically says you draw an incorrect conclusion. You draw the wrong conclusion about the results of the test or about the evidence that you've collected. And that's why it's important for us to have good professional judgment, be aware of judgment biases, be skeptical about the evidence that we're evaluating, right? So that we can reduce this non-sampling risk, so that we can draw appropriate conclusions. So any questions before we move on to the audit risk model, the relationship? So when I test you on the audit risk model, I don't care that you know how to manipulate a mathematical formula, because I'm not giving you any numbers. You will not need a calculator. What's important is that you understand the components of the audit risk model and how they work together. Right? So if I change something if I change detection risk, or if I change the risk of material misstatement, how does that impact my detection risk? How does inherent risk and control risk impact detection risk? How does detection risk impact audit risk? So know how they work together. You need to be able to critically think about the audit risk model and analyze changes in the audit risk model. The impact that it has on the nature, timing, and extent of audit procedures. I understand what that means. Does everyone understand that? So let's do a knowledge check. Some of these questions are from the quiz, so we'll cover some of the misstatement. What's the definition of a material misstatement?
It's by inherent risk and control risk.
Right. Right? So first you have to have an error enter the inherent risk creates an environment where transactions can enter, where transactions can result in a material misstatement, right? And flow through the AIS state or the client's information system, accounting information system. The controls would then prevent that. There should be controls to prevent that. So if you have a material misstatement, right, then it's consistent. You have a misstatement that has occurred because inherent risk and control risk were increased. So it's a material mistake. The risk material misstatement is inherent risk and control risk. You need both of those components to have the risk material misstatement. So you should know the answer to this question real quick. C, right? Everybody gets it. When I say risk and material misstatement, you should automatically think inherent risk and control risk. Okay. So just to summarize, the objective of the audit risk model, right, is it's a framework that auditors use to determine the nature, timing, and extent of the audit test that they're going to perform, the audit procedures that they're going to perform. Right. So, if you have lower detection rates, the auditor is willing to accept only take a low risk that they will not detect a material misstatement, given the audit procedures that they perform. Right? They're going to want to keep audit risk low. So, when you have lower detection risk, the nature of your test will be more effective tests. And what's considered more effective tests, because in this situation you have higher risk of material misstatement, right? Because there's an inverse relationship between the detection risk and the risk of material misstatement. So a more effective test would mean that you're going to perform more substantive tests of transaction and more substantive tests of detailed account balances. You're going to look at a lot more transactions. You're going to confirm a lot more accounts receivables. So you're going to perform more effective tests. The timing of those tests are going to be performed at year end, right? Because there's too much greater risk, right? So you're not going to perform tests and roll them forward. You're going to perform them at year end, or right after year end, so after the year end. And then the extent, obviously, is going to be more testing. You're going to gather more evidence. And conversely, if the auditor determines that the risk material misstatement is low, then they're willing to accept a higher risk that they're going to detect the material misstatement. And when we say less effective tests, it's a little bit of a misnomer, but the focus of the test is different, right? Because you're focused on control. So basically, you're saying when the risk material misstatement is low, that the client has effective internal controls. And so therefore the auditor is going to test more controls. The majority of their tests will be on controls. Right? Because the idea is if you have controls, because if you think about it, transactions happen the same way all the time for the most part, right? If we're talking about revenue, how many different ways is a company going to earn revenue? If it's a shipping company, right? If it's a company that ships goods to their customers, that revenue they're going to earn revenue and generate revenue the same way, right? So you can test the controls over shipping, right? So your controls are going to be the same for those transactions. And the same thing, if the controls are effective, then you could possibly go in and test controls at an interim period and then roll that forward. Test some account balances at an interim period and then roll it forward to year end. And then, obviously, you would perform fewer tests. You would confirm as many accounts receivable. You might not look at as many transactions, detailed transactions, right? Because the auditor has concluded that the risk material misstatement is low, and they're willing to confirm that they won't catch that there'll be a long audit period. So, just to recap. Combination of inherent risk and control risk is risk material misstatement. The auditor assesses risk material misstatement. Auditors control audit risk, detection risk. These two risks are, the audit risk is very much the auditor's judgment. The standards suggest that the audit risk should be low. I highly recommend that audit risk should be low or very low. But ultimately, it's the auditor's decision detection risk is the auditor's response to their assessment of the risk material in the statement, given the fact that they want to keep audit risk low. This scenario, risk is high. The risk material mistake is high. And so therefore the auditor is not willing to accept the risk that they won't catch material mistake. Okay, so let's what's inherent risk? Well, how would you assess inherent risk? How would you assess control risk? So how would you assess inherent risk? And why?
I would say high because they don't have an internal audit, and the people that are checking them, or they don't even have background in finance.
Okay. Everything okay.
Well, I would say inherent risk is higher because it has a large network of subsidiaries.
So didn't you say high? You said high.
High.
Oh, okay.
And going from where
Right.
the other one is
So you're saying that the not having an internal audit group and so forth. So anybody else? Agree, disagree? No opinion? I'll take no opinion then. All right. So given that Casey thinks inherent risk is high, so to settle and control risk, then that does what to the risk of material mistake? That makes it what? Let's hear from somebody other than Casey. Makes it high. And then what are we going to do? What's my response as the auditor?
If the more detection risk,
Right, and so what does that mean?
gather more evidence. Gather more evidence.
Gather more evidence. Okay. So inherent risk, right, is high. It's operating, as Casey pointed out, it's a very regulated industry. It's a complex business operation. There is because of the lack of the internal audit group and the oversight, it increases there's a lack of financial controls, right? So control risk, there's, as I said, not appropriate oversight by a competent audit committee or any oversight over the key financial aspects of the organization and the lack of internal control. So that is both high inherent risk and high control risk, which then translates to a high risk of material misstatement. And then as a result, the auditor is going to set detection risk at a lower level, which means gathering more evidence. Yes, was there a question? Okay, let's look at a problem. The text problem 461. So problem 461 asks you to look at several scenarios and decide on the impact on audit risk. Right? How would it impact audit risk? Whether it would increase it, decrease it, or have no effect at all. So you can work on that with your seat mates, and then we'll go over it together. All right. So here we're concerned about audit risk, right? So how is it going to impact the audit risk. And remember, what's the definition of audit risk? Blowing up the opinion, that's the easiest way. So issuing an incorrect opinion, right? So make that connection, blow something. If you issue an incorrect opinion, meaning the auditors issue an unqualified clean opinion that there are no material misstatements, and in fact, there's a material misstatement in the financials, right? So it's what we call a blown opinion. So obviously the auditor wants to keep that risk low. So, what's the impact on audit risk? For one, the company hasn't had a profit. The municipality hasn't shown a profit, and now they're showing a profit. No impact. Why?
Whether the company is making money or losing money.
So let's walk through that. I like that. I like when you give me an answer that I don't like, because then it's a teachable. So, if the company is losing money, right? Could that create incentives for them to play around with the numbers? Or if not even play around, if a company is losing money, does that then perhaps lead to going concern, their ability to continue with operations, right? So what that has, so the unique thing about this particular exercise is because even though it's asking you to consider the impact on audit risk, you have to dig through what components, because these are all client factors, right? This is a client factor. Well, how does that mean there's an impact on internal controls or inherent risk, right? So that is the fact that they haven't been making money, and then all of a sudden they're making money, might raise a red flag. And in this case, that would have an impact in terms of inherent risk, right? How the company is operating, and all of a sudden they've had this change. So it is going to have an impact because it's impacting inherent risk in some way. Now the question is, does it increase inherent risk or decrease inherent risk? Who thinks it increases inherent risk? So everybody else thinks no? Everybody else is like, I don't have a clue. Right? So here's the thing. And normally that would be sort of think about we do analytical procedures, right? When you perform analytical procedures, this all ties together. You perform analytical procedures, it's attention directing. So if the company's been operating at a loss for many years, and then all of a sudden they show a gain, your first instinct as an auditor, that should be like, whoa, what's this about? Why is it all of a sudden they're showing a gain? Now that doesn't mean that it's bad, but it's attention directing, right? So then you'd say, okay, well, why would they be showing a gain? Is there a situation that has occurred in this current year that would suggest that they would have a gain or they would show a profit? And in this case, it's because they have a federally funded grant, right? They receive federal funding. They have a federal contract. That decreases it. And the reason it decreases it is because a federal contract tends to be assured in a way, right? I mean, we don't think about the federal government going broke. Let's hope not, despite all the dire warnings that we're hearing in today's political environment, right? The federal government is not, it's almost like a guaranteed contract. You fulfill your aspect of the terms of the contract, and then you're going to get paid. You're not going to really think about the federal government not paying their bills, right? So it decreases the risk because there's an explanation for the change in their profitability status, and it's tied to a secure customer. Make sense? So because inherent risk is lower, right? It's going to, if you could keep the risk, drives down your risk, then the impact of the audit risk is it lowers the audit risk. Yeah. it's not a business risk, the company. I guess you could say, but inherent risk, I take it back. Inherent risk considers those factors about the client's environment, which the business risk is a part of their environment. Different factors influence business risk. But we're looking at this in the context of the audit risk model, and the client's business risk impact inherent risk. Right? In the audit risk model, so the factors that we look at when we're trying to assess inherent risk, because we're assessing the client's environment. So of course, any information or factors that the auditor is considering is going to come from, some of it's going to come from the client's business risk. So for an example, more directly, would be if a client has a product that had been under patent for 20 years, and now this is the year that they lost the patent expired. So there's a business risk to the company, right? That also increases inherent risk, because the reason being that now they have shown there's this risk that they will, they're not earning revenues at the same level. They've lost a significant, probably significant sales associated with that particular product, and then that you evaluate that in the context of other things going on in the business, so that could possibly increase the inherent risk unless the auditors find some other. So if they find something, they say, well, yeah, that product went up patent, but they have a whole pipeline of products under patent, so it's going to offset any change. Well, then inherent risk is not increased. So the factors that contribute to the auditor's assessment of inherent risk is definitely going to come from the client's business, which will include business risk as well, right? And factors that even the client can't control, but those also, the economy, the client can't control that, but that it creates business risk for them if they're in a sector of the economy that's doing badly. Okay, what about number 2? Yes.
It's going to higher audit risk because there's an incentive for this majority shareholders. Since he's on the board of directors, he's going to want to make the company liquid because then the stock value will be
right. There's a conflict of interest, right? And this is control. Corporate governance is not great, right? This impacts controls, thrown at the top end, and also inherent risk. Some factors cross over between inherent and control risk, right? The corporate governance structure is not very good because you have on the audit committee, on the board, a person who has control over the financial reporting process.
So if it's control, then is it risk of material mistake?
Well, it's going to impact both of those impact the risk of material mistake, right? So in this case, if you classify this as either inherent or control risk, it still impacts the risk of material mistake, right? Both of those impact. So it increases audit risk. What about I'm going to skip it, and I'm not going to go over all of them. What about number 6? There's no effect. What difference does it make when the employees are paid, right? It's not when they're paid. It's what the controls are over the payroll process. Are there sufficient and effective internal controls over the payroll process? So this has no effect. This has no effect on inherent risk or control risk. Yes.
So like when the employee comes in based on performance,
Inherent risk. Did everyone get the same question on it?
If the individual's pay is based on company performance, what kind of risk is that?
It increases inherent risk, right? Because it creates incentives for misreporting. And that's what you've seen and heard in the popular press about CEO salaries, CFO salaries, and that it's tied to, they get stock options or their bonuses are based on whether or not they meet some performance metric, and so therefore they have an incentive to report aggressively so that they can keep the numbers higher and so on and so on. Right? So that increases inherent risk. And that's one of the factors that auditors would look at. What about number 8? Does everyone agree? Yes.
Well, I think it might at the same time be increasing the risk because they're changing the system and
Right.
there might be like errors in between the
Right.
process, and also it could decrease it again because they're applying gap and it would be more structured.
Exactly. Both of you guys are right. So when you switch from from non-GAAP to GAAP, and in this case, cash to accrual basis, you increase the risk. And the reason you increase the risk because now you're on accrual-based accounting, right? And accrual-based accounting, just based on its definition, right, is going to create more subjectivity in your financial statements, right? You have to accrue expenses. So it's a more complex accounting system, and so therefore it increases risk. And there's also more opportunity for errors. Let's see. What about number 10? They remove the loss from the financial statement. Does that increase or decrease?
It would decrease it because basically the loss contingency was an estimate. So now that they know that they're for sure.
Right. You remove subjectivity. Right. So you increase your arguments. That's a line item that is no longer subjective. Okay. What about, let's do one more. 15. Increase, decrease.
Increase.
Why?
You want to make your company as good as possible.
Well, it increases your audit risk, right? Well, you're going to have that anyway, but you're right, it increases it because now it's a publicly held company. So you have a wider audience who utilize those financial statements, and you as the auditor have no idea how they interpret the financial statements, what they use it for. Right? So whereas if it's a non-publicly held company, and the audit was because the company, bank lender insisted they have an audited financial statements, then you know the party that is requiring the audit. You know their objectives and what they are requesting an audit for. So there's less uncertainty about who's using the financial statements, right? Anytime there's a publicly held company, that's going to increase audit risk because of the exposure. Okay, so this problem is an example of how I want you to think about the audit risk model, right, and the impact of how different factors could influence audit risk, inherent risk, control risk, and then ultimately detection risk. Any questions about this one? Is there any one of these that you weren't sure about? Okay. Yes.
Can I actually ask a question?
Sure.
So for number 8, it says Brown was audited TWD for 5 years. So if that includes protection risk specifically, it's because if it's been doing it for a
You said
while.
which one was that?
Number 8.
Number 8 is the cash. Number
I'm
7.
sorry, number 7. My bad. Sorry.
Okay. So what was your question? I'm sorry.
So since that has to do with the auditor that they've been auditing TWD for 5 years, would that increase the detection risk? Just because they might fall into a pattern or?
Well, so when you say increase detection risk, so remember, detection risk is what the auditor is willing to accept, right? So they would be willing to accept more risk because of the familiarity with the company, right? So and usually when you audited a company for a while, you know the company better, you know the players, you understand the business process, you know where the problem areas are, so that it just that you're more comfortable auditing that client, and you're better able to, hopefully you improve your judgment about more subjective issues, so it would decrease the audit.
You also mentioned how sometimes the client is a lot of things like,
you actually increase your engagement, that's right, because you are not approaching that audit with them as skeptically as you should, right? So you are, and that's the remember the slide, like sampling risk and non-sampling risk? Well, that's the non-sampling risk, that you're not as professionally skeptical as you should be because you've grown comfortable with the client. You don't look at things with the same level of skepticism, and you might be subconsciously, biased in favor of the client. That's going to impact how you evaluate evidence, and it could also evaluate, and it's also going to impact how you evaluate the risk of material misstatements. It could possibly have an impact on how you evaluate audit evidence. So indirectly, right, it will impact audit risk. Okay, so the risk assessment process, then, just to tie this all together, we started out talking here about the importance of the auditor gaining and the standards requiring that the auditor gain an understanding of the company and the company's environment, and that includes understanding the industry, what external factors impacting the company, the nature of the company, how they're generating revenues, what type of transactions they engage in, what type of, are they, in an environment where they have a lot of complex or subjective type transactions? What kind of the key accounting principles, the objectives and strategies, measurement and analysis. So this is what we talked about in Chapter 3 in terms of understanding the client. Then we have to understand the internal controls over financial reporting. That gets to control risk, the auditor's assessment of control risk. And that is going to impact, we're going to gather information about this, understanding the controls from the client acceptance decision, because you evaluate your client, we perform analytical procedures, the audit team gets together, brainstorm, talks about where the client's financial statements are susceptible to the risk of material misstatement. The auditor also has to speak with management and the audit committee. They assess their risk factors given these different things. So inherent risk, a lot of the inherent risk factors are going to come from this phase of understanding the client. The control risk, obviously, from understanding the controls. They then respond to that risk, which is their nature, timing, and extent of the audit procedures that they perform. More effective sustainable procedures, for example, if they determine that the risk of material misstatement is high, with procedures closer to year end, right, when they consider that as high, and the communication is obviously the audit. So, another knowledge check. What do you think? I heard B, D. Anything from over here? B. The B's happen. Identify potential problem areas. Analytical procedures cannot provide any direct evidence about the account balance. Because remember what analytical procedures are. You're looking at changes from year 1 to year 2, relationships between accounts, ratio analysis. So that's not going to tell you that's not direct evidence about the account balance. Instead, in the planning stage, you're trying to identify potential problem areas. Okay, so just some key points. Analytical procedures are required during the planning stage and the final phase, right? And it is up to the auditor whether or not they use analytical procedures during the evidence gathering phase. As I pointed out, it's meant to be attention directed, right? To be able to identify where there might be potential problems in the financial statements. So I'm going to, I already talked about assessing risk and the importance of it. That's AS 13. I want to wrap up with just a note about engagement risk. The engagement risk is the auditor's risk due to the fact that what I said, They could be exposed to litigation and damage to their professional reputation. So the auditors want to manage that risk, right? So that's why it's also important as they go through the client acceptance and continuous phase that they really evaluate whether or not this is a client that they want to continue to be involved with. Right? So there's no, I doubt that any firm is willing to accept all risk at any cost, right? Because at some point it gets to a point where you're exposed to litigation or reputational damage that you might not be able to recover from, which we saw with operators. So I'm going to end here.